Today, I'll answer several questions about loans on whole life insurance policies, but we'll start with the question, why do people use loans? There are two main reasons. The first has to do with the compounding of a life insurance policy. So if you have a whole life insurance policy and you have cash value, I'll call it $10,000. The number can be anything. But if it's $10,000 and it is earning 5%, if I just let it sit and grow, it'll earn 5%. But if I said I want to take a policy loan, say in the amount of $5,000, the maximum I can loan is typically whatever I have in cash value. That'll cost me, that might be 5%. But that 5% I was earning on the $10,000 before I took a loan, I still earn that on the full 10 grand. So taking loans do not negatively impact the compounding within my life insurance policy. So the first reason why people do this has to do with the compounding. The second reason has to do with the tax benefits. So if we do everything right, which means we follow IRS rules, which is primarily on your agent, and they'll educate you on what to do and what not to do, loans are tax-free. So when I take loans out during my working years, those are tax-free. It is very popular to see people use loans in retirement and not pay the loans back, nor the loan interest. What they're doing is taking loans, whether it's $5 grand a year, $5 grand a month, whatever the dollar figure is, because it's tax-free to supplement their income during retirement. Especially when we see tax rates going up and down and we have no control over that, this is a nice asset class to position some of our funds. So now when we pull money, we don't have to worry about anything going out the door to taxes. So those are the two main reasons why people do this. To answer the question, why people use loans, compounding, and then also the tax benefits. Question number 2, how do I get my money? A very good question here. So there are a few ways you can actually get your money through a policy loan. The first is the easiest. You can just go on your online account. And this can be a laptop, a mobile device with many companies. You can log on, request a loan, very, very simple. If you said, I'm not a tech person, I don't like computers. Another way is you can call either your agent or the insurance company. When you request a loan, it'll typically take 2 to 3 business days on average for the funds to be sent to your account via direct deposit. Sometimes it's closer to 5 business days, and it is possible for delays to occur. So one example of a delay occurring is if I request a loan through my online account and I want it to go to a different bank account that might be in my name, or maybe it's in a business that I own in a business's name, or perhaps it's in my spouse's name. The insurance company does not recognize that bank account. Therefore, they want to verify it first, which takes time. The sooner you are made aware of the need to provide that notification, the sooner the loan can be processed. One of the things we do here, because this is so important when you're dealing with people's money, is we've got a client relations department set up at our company. They've been here for several years. And the main thing they focus on is policy loans and getting those out quickly to our clients. For example, if a client requests a loan on their portal, they want it to be sent direct deposit, and the company makes a mistake and mails a check, the person's traveling, so they can't get the check, it's not gonna work, and then all of a sudden, what should take 2 or 3 days takes 2 weeks. It's like, no, you can't do that kind of stuff. This way, we've got a team that's on top of it, can immediately reach out to the insurance company, put a stop payment on the check, and then make sure that the funds are sent via direct deposit to the client. So the ways you can request it are through an online account, or you can call your agent or insurance company. You could email your agent as well, and they can prepare the paperwork for you. Typically, it's one signature needed, unless you're using a new bank account or something like that. All right, let's move on to question number 2. What is the loan interest rate? So this will vary depending on the company and sometimes the product that you select. Now, what I will always say is when we look at the interest rate, there are 2 types. There's variable loan rates and fixed loan rates. Fixed rate is fixed for the life of the contract. So to provide some examples here, if we look at some of the major mutual companies, Mass Mutual offers a fixed rate. Guardian offers a fixed rate. Actually, all Guardian policies start with a fixed rate, which is 5%. And they will actually discount that to 4.76% if you pay the loan interest out of pocket. So when it's billed on your anniversary date, if you decide to pay it, because you don't have to, then it's discounted to 4.76%. Mass has a fixed rate of 6%. And the thing about these fixed loan interest rates is that they are contractually fixed, meaning they're not going to go up down the road. No, once I start that contract, I'm locked into it. If we look at policies that were issued about 10 years ago, fixed rates were at 8%. Those policyholders still have a fixed interest rate of 8%, which is not a bad thing because insurance companies will often do things to raise your dividend rate on borrowed funds to prevent you from feeling like I'm paying more in loan interest than what I'm receiving from the company, which we'll speak more to that on the topic of direct and non-direct recognition. So that's fixed. When we look at variable rates, typically these are linked to a AAA rated bond. A lot of times I see Moody's Corporate Bond Index. It's a AAA rated bond. So usually a company can adjust this every month, and you will see that. So call it monthly adjustments. But a policyholder can experience an adjustment one time per year. So we'll call it one time per year adjustment. Okay, so what this means is if you look at Mass Mutual or New York Life, their variable loan rates function very, very similarly. It's tied to Moody's Corporate Bond Index. And if you look at their March rate as a company, it's 5.07%. If we look at what it's going to be in April, it's going to be 5.83%, which is a big jump. We typically don't see it jump that high month to month, but that's a jump. So if I start a policy in March, my loan interest rate is 5.07%. The next month, when the company's rate goes up to 5.83%, I'm locked in at that 5.07%. So as a policyholder, if my start date is March, then I lock in that rate for a full 12 months. That cannot be updated until March of the following year, which what will happen then is the insurance company will say, here's our loan interest rate for March, and now we're going to assess this loan interest rate to your policy. Now, you'll often see what is called a trigger associated with your policy. Sticking with the example of Mass Mutual and New York Life, they use a trigger of 50 basis points or 0.5%. Here's how it works. If I start with that loan rate of 5.07%, that's in March of 2025. If in March of 2026, the company's loan rate is, let's say, 5.5%, your rate will not go up because the increase is less than 0.5% of what you had last year. If the company's rate is 5.83%, again, this is March of 2026, you will experience an increase because you were at 5.07%, and 5.83 is more than 0.5%. So what hits that trigger is an increase of more than 50 basis points. On the flip side, however, there's no trigger. So if it goes down 1 basis point, 30 basis points, whatever, I typically still experience that decrease. You will, however, see floors with variable loan interest rates. Depends on the guaranteed interest rate with your product. So for example, sticking with Mass Mutual this time, if I look at a Mass Mutual 10-pay, what you'll notice is that the variable rate floor is 3%. That's as low as it can go. The 10-pay guaranteed rate is 2%. If I look at their high yearly cash value product, that product has a variable loan rate floor of 4%, which is as low as it can go. Why the floor is not as attractive as the 10 pay is because the guaranteed rate is 3%. So the floor, which is as low as that variable loan rate can be, is usually whatever your contract guaranteed rate is plus 1%. We typically see that with variable loan rates. Now, there's a lot more to it when we look at both fixed and variable loan rates. An example of that is Guardian. What they do with their fixed loan rates is typically at age 65. You'll see provisions in there where the fixed rate drops to 3 to 3.5%, depending on the product. They do that because they know people are taking income from these products on a tax-free basis. So there's some really nice things to be aware of when we look at different provisions. And again, these are just a few examples here. But the loan interest rate will be fixed or variable, and there's definitely material to be aware of when I dig into it. Interesting stuff, right? It is, and boy, do I love it. So next question. Loan interest accrual. So this is a really good question because what we hear in terms of misinformation sometimes, that if you take a loan today and you pay it back before 1 year, you don't pay any loan interest. That is not true. Loan interest with a life insurance policy accrues daily at what is called annual simple interest. What does that mean? That was my question when someone said that. They don't make this stuff easy, trust me. So let's hit on the daily piece first. Let's assume you take a loan of $10,000. Okay. We'll assume that the interest rate is 5%. Simple math. 5% of $10,000 is $500. Sweet. Okay. If you take a $10,000 loan on the beginning of your anniversary date and you have a full year for the loan interest to accrue, what you will notice is that every day a little bit of loan interest will be added to your account. What you would want to do is take this, divide it by 365 days in a year, and that would give you, comes out to like $1.37 per day. That's the loan interest that will accrue every day. Now, after 6 months, here's a simple way to look at it. If you looked at your loan payoff amount, it'd be $10,250 because the loan interest accrues over the course of the year. So it accrues daily, and then what at annual simple interest means is that it is simple interest over the course of the policy year. So for example, taking that $10,000 loan at the beginning of your policy year on your anniversary date, you're going to see $1.37 accrue every single day, meaning that interest is not going to compound over the course of the year. Now, why insurance companies say annual simple interest is because on your anniversary date, you will be billed for the loan interest. So if you have this $10,000 loan that you took and it has accrued $500 in interest because you paid nothing, what'll happen at the 12-month mark, you get a bill for $500. If you pay it, the same cycle will repeat. If it's a variable loan rate, it's going to be based on the updated rate. But what happens if you don't pay it? Well, if you don't pay the loan interest, then that $500 is added to the balance, and then at 5%, begins to accrue on the $10,500. So it does compound if we don't pay it. It just accrues at simple interest over the course of each year, which is always a good point to hit on because the verbiage is confusing in the industry. I was never a fan of it. Some people ask, why do they do that? Well, I do not have an answer for that, unfortunately. All right, next question. How can I pay loans? So this is similar to how you can get loans. It's very, very simple. It can be through your online portal, you can mail in a check, or it could be a wire transfer. The online portal can also include your mobile app. So it's very simple to make payments. I will say that you can make payments at leisure. You can just go onto your online account and throw money at the balance, kind of like a credit card bill, or you can set it up on auto pay. A A lot of companies will have that. Not a lot of companies, the major mutuals do, I know for a fact. Like you can do that with Mass Mutual and Guardian. A lot of clients we work with will do exactly that. But you've got the option. And you, the policyholder, can pivot as time passes. So you don't have to feel like you have to ask your agent or ask for permission every time you want to make a change. It's like, no, it's your money. Let me do what I want with this, what I want to do, and then have my agent provide some guidance over time. So how can I pay? It can be at leisure or auto pay, and it's very, very simple too, which is cool. Next question. How soon can I borrow against a life insurance policy? Which is a very good question. So it's typically 10 days, specifically 10 business days. So we've had a lot of people start their policies, and then 10 business days after starting, they'll turn around and request a loan. Now, this 10-day rule can also apply anytime I make a premium payment, PUA payment, or loan repayment. What some insurance companies want to see is that any payments we make to them clear from our bank account. This way, when we turn around and request a loan, they know that the money is 100% there. Now, some say it doesn't take 10 business days for funds to clear from a bank account. You are correct. Insurance companies are very conservative in this respect. With that said, if you wanted it sooner, you can get it sooner. We've had some people do it in 1 to 2 business days. What's needed here is a bank statement or something to verify that the funds have indeed cleared from your bank account. We've had a lot of people do this because it just shows the proof to the company, they're comfortable, and then they turn around and send that loan. But you can borrow 10 days after starting a policy. The one thing I'll mention here, actually, this doesn't happen all the time, but definitely good to be aware of. What we'll see in survivorship policies, specifically in the contract language, sometimes they do want you to wait a full policy year, which is usually 12 months. And then after the first year, you can take loans. But if you're getting a standard single life policy, which is what 99.9% of people get, then it can be 10 business days. And then if you have a survivorship after 1 year, the same 10 business day rule would apply. Cool. All right, next question. What is the maximum that I can borrow? This will depend on the company, but the maximum is usually 95 to 100% of whatever your net cash value is. So to clarify the net cash value, if you start with a policy, you've got cash value of $10,000, just to make it simple. No loans outstanding. You could borrow 95 to 100% of that. Again, depends on the company. If you take a $5,000 loan, you still earn dividends and interest on the full 10, but you'll see on your online account what is called your net cash value, which represents the cash value net of any loans. In this example, it'll be about $5,000. Maybe a little bit less after we account for the loan interest, but if you have a loan outstanding, then that 95 to 100% is going to be 95 to 100% of the net cash value, whatever is remaining. And then if you make any loan payments, that'll immediately restore that, which is cool. All right. So maximum I can borrow, usually 95 to 100%. Bada bing, bada bam. Non-direct or direct recognition. Doesn't matter. Which one should I go with? It does not matter. It really doesn't when we look at the net numbers, how they work. If you're new to these terms, non-direct recognition means that the life insurance company does not recognize when you take a loan with respect to how they apply dividends and interest to your policy. So for example, with a non-direct recognition policy, if I have $100,000 in CV, cash value, and I take a $50,000 loan, and my dividend interest rate is 6%, they do not recognize the fact that I take out loans, and therefore I'm going to receive that same 6% dividend still on the full $100,000 in cash value. Whereas Direct recognition does recognize the fact that you take out a loan. So if I have the exact same scenario where I've got $100K in cash value and I take a $50,000 loan, I will still get dividends on my entire $100,000 cash value. I want to clarify that point. I will still receive dividends on my full $100,000 in cash value with direct recognition. The difference is the amount that's loaned receives a different dividend. So the net cash value, if my dividend rate was 6%, the net gets that 6% dividend. The loan cash value still receives a dividend, but it could be higher or lower. It depends on the company. If you look at MassMutual, who currently has a 6% fixed loan interest rate, if I select their fixed loan rate, I receive a direct recognition policy, they raise the dividend on borrowed funds. If I have an old Guardian policy with an 8% fixed loan rate or a 6% fixed loan rate, what you'll notice is that the dividend applied to the loan cash value matches the loan interest rate. Northwestern Mutual, with some of their old contracts, has a fixed loan interest rate of 8%. And what you'll see in the provisions of those loans and direct recognition is that they raise the dividend rate to 7% for the first 20 years anytime I take a loan. And then from year 21 onward, they raise the dividend to 7.75% to help make up for that very, very high fixed loan interest rate. And then in some cases, you will see the company reduce the dividend rate applied to the loaned portion of the cash value. Usually what we see in situations like that, though, is I'm paying a much lower fixed loan interest rate. So when I factor in my net cost to borrow and how much I'm paying the insurance company in a loan interest, there's not much difference. Like, I have never seen a case where it just says it's easier or better to go with non-direct recognition. It is easier to understand, but when you look at the actual numbers, it doesn't make a difference. I've not seen any evidence of that when we look at actual policies, which does not include an illustration, because I can make one look better than the other if I wanted to. That would be very easy, but it would also not be right, in my opinion. All right, so non-direct or direct recognition, doesn't matter. No, in my opinion. If you'd like to see numbers, we've got a nice case study above that goes through a Guardian policy with both their direct and non-direct recognition option, and we break down the dividends applied versus the loan interest paid. Tax deductible. This is a good question. So generally, no. Per the IRS rules, you cannot deduct the loan interest. However, in working with many CPAs, if you are using a policy loan for business purposes, in many cases, we can then deduct the loan interest. CPAs will say, yes, you can do that, and we've seen people successfully do that. With that said, for those who are very, very conservative, when they read the IRS language, it says, no, you can't do it. They just prefer not to try to deduct loan interest, which I fully respect. If you still are using a loan for business purposes, a sure bet option is what you can do is go to a bank and get a CSV loan, a line of credit where you assign your cash value as collateral to the bank. I'll call it a cash value collateral loan a lot of times. But on the bank's paperwork, you can check off that this is a business loan, which from a tax deduction standpoint makes it very, very simple. One of the most conservative CPAs I know, that's got like 18 policies with us, prefers to do that because he is just super conservative and never wants to do anything that could even be thought to be questioned by the IRS, which again, I fully respect. So tax deductible, generally no, but there are ways to deduct the interest if I'm using it for business purposes or anything that can normally be deducted in terms of an interest cost. Full disclosure, none of this is to be considered as tax advice, as we are not accountant or tax professionals. Okay, next question. Do I have to pay it back? So in 95% of cases, no, you do not have to repay loans. However, if I take the maximum loan out, let's say I borrow 95%, my premium's due. I don't pay the premium. The loan interest is due. I don't pay the loan interest. If the loan interest exceeds the dividends and interest that are being applied to my policy, because the dividends need to cover my premium and cover the loan interest, if it can't do that, that would be a situation where I would have to pay the policy loan Otherwise, it would lapse, which is not good. We don't want that to occur. So in 95% of cases, no. If I have maximum loans outstanding, that would be a situation where it could lapse. If I have a policy with what is called an overloan protection rider, that can protect me from that situation as well, which is nice. But in most cases, it'll be no, especially once you have a policy in place for a while. And also, you can always forecast this years out. So if you plan on heavily loaning from your policy and you can't pay it back for whatever reason, you can see it on an illustration to say, well, we do need to pay something toward the interest or premium over the next few years. Otherwise, 4 years from now, we could see a small amount due or it might lapse. So it is very easy to forecast in that respect. The last two questions we're going to hit on with some visuals. What happens if I don't pay my loan interest? And what happens if I pay the loan back? So if I don't pay my loan interest, what happens is the policy will take a loan against the cash value to pay that loan interest. And my death benefit will also reduce by the amount of that loan that was taken to cover the loan interest. So I will see an impact on my policy if I don't pay the interest. We're going to look at an example in a minute, and then we'll look at an example of what happens if I pay it back, which the numbers will look good. So we're going to look at an actual policy here of someone who is about to hit policy year 9 when we look at it. So he's had his policy for a while now. Here's the premium that's due at age 43. However, he is not going to pay it this year. I just spoke with his father yesterday. He said, I prefer not to pay it right now. I want to pay it later. So what we would see here, the loan would be taken to pay the premium. He also has a large loan outstanding, so a loan would also be taken to pay the loan interest. So in year 9, which he's about to start, he doesn't want to pay anything toward the premium or the loan interest. Therefore, a loan needs to be processed to pay both. Should rephrase. He could elect to have his dividends and interest pay the premium instead, but he doesn't want to do that. This is a short-term strategy because he does plan on paying this loan later. But when he does this, that loan balance goes up, which is important to be aware of. All right, then we've got the cash value and death benefit. Check this out. His loan was about $45,000 that was processed. It's processed to pay the premium and pay the interest. His cash value went down a little bit more than $2,000 with a $45,000 loan processed. How? The dividends and interest that are being produced in this policy helped cover the majority of that loan balance. Then we also see that the death benefit went down. So then next year, he does plan on paying the premium. After the 10th year, he plans on paying nothing. This is a 10-pay policy. So his out-of-pocket regarding premium payments or loan payments is 0. Here's the loan interest that compounds every year, and you can see the impact on the balance. Then the net cash value and net death benefit reflect the net values that he, A, has in cash value, and B, what would be paid out if he were to pass. How's it look? Not bad. Continues to appreciate over time with that large loan as well. That's the case as we scroll down. So he is in very good shape based on the amount of money he's paid into the policy. And I like this example because he's borrowed close to 90% of his total cash value when we look at it. And he's still in a situation where it keeps on compounding. This is an example of forecasting things. All right, let's look at an example that shows what things look like if he pays it back. So this will be fun to look at. So we've got the same policy here on the left or to the left, same situation. So this year, doesn't want to pay anything. No premium payment. There's the loan to pay the premium, and then also a loan to pay the loan interest. Then what he's going to do is pay $36,000 per year or $3,000 per month toward the loan. We can see how much is applied to the loan interest and how much is applied to the loan principal. We get these figures directly from the formal illustration from the insurance company. I just put them on Excel because I like the colors and it makes it easier for most people to follow. At least it makes it easier for me. I like to think I'm like most people, but a lot of people think I'm strange. All right, as we pay it back, we can see the impact that those repayments have on the loan balance, and then also on the cash value and death benefit. You see it restored. Very nice. And then it continues to compound after that. In his specific situation, he had initially aggressively funded the policy, then he took his foot off the gas, used loans to cover the premium, also used loans for personal and business use. And his strategy is really to get through the 10th year, and then after that, with no more premium being due, then he'll begin to focus on repaying the loan. He liked that strategy, it didn't stress him out, and it allows him to focus on one thing at a time. First, funding it, taking loans for business, and then after the premium's done, I've funded it for my obligation that he had in his mind with respect to a plan, then begin to attack the loan. So, if I don't pay the loan interest, it will compound. If I pay it back, everything's restored and the numbers look great. So I hope you enjoyed this video. If you'd like more videos like this, please let us know in the comments below. If you'd like more information on policy loans and to see application as far as how people use them, you can check out our 3-step guide to using a policy to buy real estate here. And as always, I hope this helps.